Hey everyone, in this short video, I'm going to talk about how Nikola is slashing costs in order to boost profitability and reduce cash burn. The data I'm going to use in this video is coming straight from Nikola's CFO in the company's latest earnings call. So let's get right into it, starting with them announcing that they closed down battery production operations in Rome, reduced their headcounts in Phoenix and in Coolidge by more than 20%, completed the sale of their European joint venture to another company, and went through a company-wide cost rationalization effort to ensure that every dollar spent is in line with the company's priorities. And this was a good move in my opinion, because the company was starting to get really short on cash, and reducing that cash burn rate will give the company more time to reach what they say will be EBITDA positive by 2025. So these moves will give the company more time. Now, what it also did is they accomplished their cash burn rate below their $150 million target. And they have high visibility, meaning they have ways where they feel confident that they can reduce their cash burn to below 100 million per quarter by the end of this year. So the company is doing a good job reducing how much cash they're burning every quarter, which will then reduce how much cash they need to raise, which will then get them closer to being just a self-sustaining business, which will be a big boost to Nikola stock investors, because one of the big risks associated with the company is that they're going to run out of money. They're not going to have enough capital in order to reach a self-sustaining level. But these moves make it closer, give it a big boost towards that direction. Also helping Nikola was that they sold 45 battery electric trucks for revenue of 14.9 million and net truck revenue of 12 million after they paid 2.9 million dollars in dealer incentives to help the company sell those trucks. So excluding those dealer rebates, the average sales price for the battery electric truck was approximately 324,000 per unit. That was unchanged from the first quarter. However, they continue to see improvements in gross profit margin, which came in at negative 180%. That was an improvement from the previous quarter of negative 213%. So as they're increasing production, increasing sales, they're reducing those losses on the bottom line. And that's what investors are looking for. Just make progress. Reduce the losses on the bottom line, reduce the cash burn, get yourself closer to self-sustaining, and then you can work on getting profitable, ramping up production, and all of the other grand ambitions that you have for the industry. You'll get there, but first ensure your survival. First secure your survival, and then you can focus on the big ambitions, right? And so both on both trucks, remember, they're now doing not only battery electric trucks, but they're also doing hydrogen fuel trucks. But on both trucks, they feel they have ample opportunities to reduce the cost of goods as the scale, volume, and localize as they scale volume and localize their supply chain. So they see opportunities where they can make progress to reduce costs and make progress towards lowering those losses on the bottom line. So during the quarter, cash burn was 148.2 million, better than the 150 million target. And then I also like this other move they announced, which is that they're now switching to a build to order production model, meaning they're not going to build trucks until it has a buyer. Every truck built is going to have a buyer associated with it before it begins production. And that lowers risk for the company, that lowers the cash need, because that's lowering your time from the cash you spend on building the truck to the time it goes to a buyer and when you get your cash back. If it has to sit in inventory for a month, that's cash that's sitting there for a month. And with the average selling price over $300,000, that's $300,000 per truck that's sitting there, that you can use that cash in building new trucks or in maintaining business operations. So good news out of Nikola, excellent progress, slashing costs and improving progress towards profitability, going from negative 213% gross profit margin to negative 180% gross profit margin. But those are still massive losses adding up, and there's still a long way to go before the company will, or if it ever reaches profitability on the bottom line. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.